kind of messes up my hair.
Everybody loose? Everybody excited?
Good
yes?
to go.
I mean, this is like a fun house for me in here.
Oh, you haven't been here yet?
Mm-mm.
So we had you on the show from Houston.
Yeah.
It just occurred to me.
Mm-hmm.
Okay. What's the wealth management business like in Houston? My understanding is everything runs through the Fertitta family. And if you're not in, you're out.
Nah.
It's not like that?
So we're actually in Dallas. I go back and forth between Houston and Dallas, but
Okay.
Requisite's in Dallas.
Right.
You know what? It is thriving. If
Yeah.
you took the jump to be independent,
Yeah.
which we did 7 years ago, it's like on Matrix, one of the best movies, do you take the red pill or the blue pill?
Yeah.
I think the blue pill is where
Wait,
you
where
know
were you? Where were
everything.
you before you
Wait,
went
what?
independent?
I was at UBS for
Okay.
2002 to 2017.
Yeah.
So,
Oh, wow.
Yeah, a long time. And then I was at Bear Stearns before that.
The wirehouses are still very powerful though in Dallas and in Houston.
Wait, where were you before Requisite? Were you a prerequisite?
But a
Look
bunch.
at you.
Yeah. You
Well
know,
done, Michael.
Thank you.
I see an unsolved Rubik's Cube up there.
Yeah.
If you give it to me, I'll solve
Do
it.
you
while we're
know? So
talking.
my 7-year-old is obsessed
I
with the
wanna see
Rubik's Cube. They have an
Yeah.
app on the iPad where you take a photo and it tells you how to.
This is like I
Kids these
have one in
days.
my
Oh, yeah,
I have one in my
I've seen that.
briefcase.
It's a cheat code for a
Yeah.
Rubik's Cube.
Wait, time out.
Wait, are you about to Rubik's?
Are you
Wait,
se- are you
hold on.
seriously doing this?
Yeah, I have one in my briefcase.
Wait, I can't see that.
Yeah,
I need to be
yeah,
able to.
yeah.
Okay, well, okay. You start with the yellow, and I'm going to make a cross with the white.
Why do you start with the yellow?
You always do, because so.
Math? Because math?
Hey, Josh, she's working. This is very exciting.
Yeah, I mean, it's going to take me 3 minutes to solve it. So if we want to like talk,
Okay.
I can solve
It'll
it
take
after
me 30
the show.
years, so that's okay.
Okay, so now it's
All
like
right.
this, and then you match the color. Like I need
I'm
to.
sorry.
Put,
It's like what? It's yellow in the middle and whites all
yeah,
around,
and
like
then
a
white's on
plus
the other
sign.
side, right? So there's
Okay.
blues lined up, and so I'm going to go like this. I'm going to line up the red.
This is mesmerizing and also a little bit boring, but also
I know
a little
that's
bit
what I'm saying. We can
mesmerizing.
talk. We can talk and do.
No.
it.
I want to see. You seem very definitive in the moves you're making. You're not thinking about it.
Oh, right. Because I mean, I do it all the
It's a
time.
formula.
You're acting on instinct. It's almost like
I
the
don't even
training
really have
kicks
to
in.
look at it.
Do you have to get one side? You can't get one side first. You have to get all the sides at once,
That's
right?
ridiculous.
Okay, I don't.
No. You can't get all the sides at first. And so,
Tom, what's the Rubik's Cube of ETFs?
Oh man. Probably
Y'all are
the buffer
mesmerized,
ones.
Okay.
oh yeah, those are great.
So while you're doing that,
Yeah,
I'm
let's
actually
talk.
going to put Tom in handcuffs and have himself get himself out.
Okay. Like a little Houdini trick.
Yeah.
Right?
Oh, look at you!
No, I messed up one there.
Look at you go, though.
I know. Yeah.
This is-
I'll get
Oh, wow.
I'll get the before.
You see what's going on over
She's
here?
almost done.
So now I have the top, and then I have the first layer.
Okay.
So you go layer by layer.
Yeah.
So, well, we can
All right.
start.
All right. Fine. It's like a portfolio.
Did the
When
bear market just start?
I think it did.
What's it down today? Yeah, is that this top
Today
signal?
is the first day of the bear
Rubik's Cube?
market.
S&P's down 2%. Equal weight's down $1.60.
Well, small was down like 3 at one point.
Small
What's
should
it-
never have been up 12 to begin with, though.
Wait, what was the deal with the XLK rebalance? It's like all NVIDIA now?
Yes.
What happened there? I don't get it.
It's just a wonky old rule that they had.
Because XLK is down. The reason I said
Yeah.
XLK is down 4.6%.
So they timed that trade perfectly, but because now they're going to have to undo that whole trade because they sold Apple, bought NVIDIA. But Apple's been beating NVIDIA since the rebound. So they're just going to have to buy all that Apple back and sell NVIDIA. So essentially they were
when
under.
was that?
This was on the calendar quarter, so like in end of June. So they were underweight NVIDIA this whole run up. And then they went really overweight NVIDIA with this while this has been going down. And the underweight Apple. It's just this old wonky rule. They cap it at 4%.
Whose rule is it?
It's just an old index methodology rule.
Okay.
S&Ps?
Yeah, it came down from like diversification rules, but at the time when these were created, like in the 90s, they didn't think about it, right? So they were just like either had all the tech boom, so they were like capping these names from getting too big. And it's just like a legacy rule that stayed with the
They
ETF.
probably couldn't have contemplated the current state of the index and
Totally.
the size of these companies and the share price moves. It's probably like hard for them to picture that ever
Exactly.
happening.
Yeah, like
So-
5 years ago, NVIDIA was 300 in the S&P, and that went to 1 in just like a couple of years. So I don't think they
Brent's almost done.
anticipated
No,
that they
I'm
would
not.
do
But
that.
I'm getting there. But I think also, investors have to be really careful with these sectors because they're so wonky the way they're
Yeah.
created. You have like 2 stocks or 40% of a sector.
The discretionary
it's-
too. It's Tesla and Amazon, right?
Yeah.
And so it's like, how's consumer discretionary doing? You can't look at that index to tell
You know whose
that.
sectors are important too? Sell side Wall Street firms who need to organize their analysts based on coverage universe. No one else should pay any attention, honestly.
I agree.
Now, I look at sectors to understand what's happening in the markets as a shorthand, but like that's pretty much it. I would never say like, oh, I want to have a sector specific portfolio and try to outperform, the XLK or something. Yeah. It seems like an absurd thing to even worry about for most investors.
I think it's like growth and value. It's like something from the 90s or 2000 that still is here today.
You're not a proponent of classifying the market by growth and value?
No, I think that's something of a relic of the
I like that.
So speaking of sectors, I just had
that.
Chart could do this before we hopped on. 4 sectors are down 2% today. It's 3 o'clock, so maybe it's more.
Tech and communications.
The 4 of them are down.
Oh, 4.
The last time 4 sectors down 2% on a day was like October 2023. So it's a pretty ugly day.
I think these are actually cattle from my ranch in Kauai.
Mark?
By the way, these are what they're called. Mark's cows.
Delicious cows.
Delicious Mark's cows.
Speaking of sectors.
There you go. Okay. Yeah, no,
next time we do, so Mark came up to my house and we made Philly cheesesteak together. Next time you're bringing the cow.
I'd say you did. I was more of a sous chef. but it was really good. It was really good.
That sous chef comment. Okay, listen.
And then at the end of the night, though, you were like, hey, so you ate enough, right? And I was like, I don't know. I could eat another one. You're like, really?
Usually when you say something like,
you were being polite. I was definitely like, yeah, we're making more cheese.
Did you get enough to eat? Usually your guest says, oh, yeah, I'm fine.
Make me another cheesesteak, Jensen.
That's awkward.
It is awkward.
So just to let you know how OCD he is, so I turn around, I'm prepping the cheesesteak, and I said, Mark, cut the tomatoes. And so Mark, I handed him a knife.
Yeah, I'm a precision cutter.
And so he cuts the tomatoes. Every single one of them are perfectly to the exact millimeter. But the really interesting thing is I was expecting all the tomatoes to be sliced and kind of stacked up, kind of like a deck of cards. And but when I turned around, he said he needed another plate. And the reason for that was because all of the tomatoes he cut, none of them touched each other.
That's insane.
Once he separates one slice of tomato from the other tomato, they shall not touch again.
Yeah, look, man, if you wanted them to touch, you needed to tell me that, right? That's why I'm just the sous chef.
That's kind of funny.
That's why he needs an AI that doesn't judge.
Yeah, it's like...
All right, that's Jensen Huang and Mark Zuckerberg doing shtick, I guess.
The last part was kind of funny.
These are like number 3 and 5 of the 10 most wealthiest people, maybe who ever lived. And
don't you guys think Mark Zuckerberg is coming to his own self? He's like become much cooler.
I like him now.
He's foiling.
Yeah,
he's got curly hair.
He's relatable.
Yeah,
he probably can't do a Rubik's Cube anymore. He probably forgot how.
He probably forgot how.
So he has the curly hair. They actually made a joke. By the way,
he looks like Jesse Eisinger now.
By the way, I would not have known that there was a talk between Jensen Huang and Mark Zuckerberg if not for the Quarter app. I have alerts on certain stocks, and I'm long NVIDIA. So it told me, hey, there was this thing that happened with Zuckerberg and Jensen Huang, and I listened to it, and it was great. And it was part of like a big NVIDIA graphics conference, and Mark was, I guess, the guest of honor. But the Quarter app is really great because it just would let me know something that otherwise, and you press play. It's like a podcast. It's just, you just have it.
I think in our business, there's I think we're AI as an RIA firm, we're seeing the productivity so quickly. And during earnings season, the Quarter app is the only app you need on your phone.
Yes.
It's the best, right? It's my favorite.
So shout out to the guys at Quarter. And obviously, we've said this before, we're investors in Quarter. But I'm a power user now. Michael's probably the biggest power user.
I left.
You say?
Yeah, I do.
Yeah. But I'm in there too. One of the interesting things about Zuckerberg now that he's like hot, and his social media team is really on it, and he's posting memes of himself surfing and all the things that he's doing.
No more whiteface.
Yeah,
with all the zinc.
And
he's not doing that anymore.
And his hair looks great. And he grew it out, and he's naturally curly, but it looks like they're relaxing it, right? So I was thinking the next step should be a face tattoo. He should go full Post Malone. Just a few words and random symbols somewhere on his cheeks. Something I feel is the only place you go from that.
Anyway,
how are we doing with the cube?
I'm good. I'm talking and listening.
All right. Why don't we start the show, John? You got your slate?
Yeah.
All right. All right.
Man.
3 clocks coming in.
Look at you go.
Wow.
All right.
That's incredible.
Almost done. Amazing.
That works. 3 claps.
The second clap is the one.
Compound and Friends, episode 152.
Today's show is brought to you by Calamos. With its roots in convertible bonds and options expertise, Calamos has been an innovator in risk-managed securities focused on equity-like upside with bond-like downside protection.
We spoke about this on the show today. I call them equity ETFs with guardrails.
Michael, if people want to learn more about these types of investment strategies, where do they go?
Go to the link in the show notes.
Ladies and gentlemen, welcome to the Compound and Friends. I'm one of your 2 hosts. My name is Downtown Josh Brown. For first-time listeners, my co-host, Mr. Michael Batnick.
Hello. Good afternoon.
We have 2 very special guests here. A returning champion, Bryn Talkington, is a managing partner, co-founder of Requisite Capital Management with a focus on capital markets, alternatives, and investor behavior. Prior to Requisite, Bryn spent 15 years at UBS Asset Management and worked at Bear Stearns. Welcome back to the show, Bryn.
Thanks. So great to be here.
You know you're one of my favorite people, right?
Thank you.
I always say this.
I've heard him say that.
I really have.
Oh, that means a lot. Thank you.
And joining us for the first time and wondering what the is going on. I'm gonna do this the right way. Athanasios. Yes?
Yeah, very
All right,
good.
We're gonna call you Tom. Can you help me with the last name?
Yeah, Psarofagis.
Psarofagis.
Yeah.
That's not how it's spelled though.
No,
P-
the P is
the P.
silent. Throws everyone off.
Okay, very cool. Now you're Italian? Okay.
Irish.
Great. Tom is an ETF analyst for Bloomberg Intelligence. Prior to joining Bloomberg, he held roles in ETF groups at Oppenheimer Funds and Index IQ and worked in product development at NASDAQ. Tom, welcome to the show.
Yeah, glad to be on.
We're so happy to have you here. Let's start with the FOMC reaction, which is weird. It's like a 2-day reaction at this point. So a day and a half reaction. So everything seemed all good after.
Yep.
Everyone was happy with the fact that there was no cut, but cuts are coming. They hinted the hell out of it. Like they did everything that they could make you do to know that it's coming. But we have till September 18th and it's only August 1st. That's a really, really long time in market. And then today we got an initial jobless claims report that I think spooked people. And now there's a lot of second guessing. Wait, why didn't they go in July? Which, by the way, is what I said they should have done. I don't know. Market reactions are always interesting after the FOMC, but this one seems bigger than what we've seen. Is that recency bias or
What do you think, Bryn?
Well, I think that, 2 things. July was probably the right thing to do.
Yeah, of course it was.
But the reality is, unfortunately, the Fed has only engineered a soft landing 10% of the time because they wait till they get hit in the head and the data is right in front of them.
Yeah.
And understand every data number we get is in the past. And so you would think with 400 PhDs and really smart people, they could actually do some forecasting and like some educated guessing.
They don't want to do
but they don't do that. And so I think it was actually the manufacturing data also is weaker.
Yep.
ISM.
Right. And so because this morning, like everyone accepted Meta's numbers, like those are fine. Mark was very candid. He's going to spend more. He was honest about it. That was up. And then that manufacturing number came out. I think that really unwound everything of that, hey, bad news is bad news.
Today is the first like really risk-off day that I can remember in a while. You've got, as we mentioned in the cold open, the S&P is down 2%, the equal weight is down 1.6%, but you've got utilities right now, HOD up 1.5%, consumer staples highs of the day, healthcare as well, 3 notoriously defensive sectors. It's been a while since we saw everything blood red, except for the most defensive names in the market. It's been a while.
Tom, one of the things that market watchers spent most of the summer doing is these charts about how long it's been since we've had a down 2% day. So now we got two weeks in a row. Do you think that this feels any different than the one that happened last week, which I think we had a huge rally the next day anyway?
Yeah, we did. And we had the rally the day before too. It always seems like, I don't know why these days of like really aggressive outperformance, underperformance, why do they always cluster together, right? And I don't know if that's just the beginning of a rotation. And because we've looked at some stats, like what happens when small cap comes up a lot, right? So the rotation from small to large and vice versa. Again, these days tend to cluster all the time. And it seems like the last time there was this clustering, it opened up the door for small caps. Not saying it's going to outperform, but there's always seems to be a reversal period against these really aggressive clustering.
But usually at bottoms or in bear markets, we're seeing that in obviously a bull market. It's interesting. Maybe NVIDIA is the poster child of what we're talking about. 2 days ago, it was down, I don't know, like 9% or something. And then Microsoft came out, gap down 7%. NVIDIA was down 4% in the after hours, but then AMD came out and NVIDIA was up 7% or whatever. Then yesterday, NVIDIA had the largest single market cap added day of any stock of all time.
What was the dollar
It was
amount?
up $330 billion yesterday because AMD, which is a proxy for NVIDIA, reported great earnings. Now today, it's down 8%, giving that all back. And that's like not exactly healthy market behavior.
No, it's I think also investors need to understand 20 years ago you didn't have this algorithmic trading and zero date to expiration options. And so I think between the algorithmic trading with all the dark pools, hedge funds, et cetera, is creating this like rotation out of NVIDIA into small cap made no fundamental sense. It was a short covering, then you had the options move come in and you get this flush to the upside.
You're absolutely right.
What that's just where we are.
Like products like NVDL.
Yeah.
I don't know exactly how they're impacting the market, but they are.
They're amplifying it.
Yeah,
I said today on TV, I wanted to ask you about this, Tom. I was saying, like, this is the biggest casino in the world right now, NVIDIA alone. The amount of options volume, zero-day options, weekly options, just the amount of overall share turnover in a given day, almost nothing that happens with the stock is based on anything fundamental. It's just gamblers against other gamblers, and some days some win, some days the others win. And nothing has really changed with the story at all. You see it the same way?
Yeah, no, and in the NVDL you just mentioned, it's like a top 10 traded ETF overall. That's insane. Like it's
so
up
for the
there.
listener, NVDL is the 2x NVIDIA
levered
leverage.
long.
So it's supposed to give you on a daily basis, not long term. It's supposed to give you twice whatever NVIDIA does up or down.
Yes.
Okay.
And I think the ETFs brought in a lot of different like investor bases, right? Before it was like you're either doing options or what. And now the ETFs makes it so easy. That thing's got what, $5 billion or so in it.
And it started at $200 million on the year.
Amazing.
We weren't that impressed when they first came out. Like, why would you buy a single stock ETF? Like, this makes no sense. And we were completely like overwhelmed with
because you weren't thinking like a DGen.
Yeah, exactly.
Well, also, it's not a single stock ETF. It's a single stock ETF with leverage.
Leverage.
You would not buy a 1-for-1.
No. So you can always make the case. People are like, well, you can just margin the account on your Schwab, through Schwab. But this is so much easier,
Yeah,
right?
I want to do it in my IRA.
You don't have to do it. Right. Or you can short it. Exactly. You can't do it in that.
Can't do it in an IRA.
This bypasses a lot of it.
Do days like today lead to more aggressive trading of NVIDIA or less? Do people get cleaned out and then just say, I'm done playing that game?
So I'm looking right now. NVDL, it has explosive volume today. Tons.
Right, but what happens tomorrow? Do people say, well, I'm not doing that ever again? Or do they want to do
But
that anymore?
here's what we know. Like why would the volatility wane right now? It's like the VIX in general is elevated. NVIDIA is elevated, but here's what we know for certain. At the end of the month, they're going to crush earnings. And the stock is just getting cheaper and cheaper from a multiple because if AMD, which really doesn't even have the goods that NVIDIA does, that AMD—
Not even close, by the way.
Right, not even close, crushes it. And like frenemies, Mark and Jensen are now, besties, is telling you that NVIDIA is going to have great numbers.
Well, you're right. Because, there was a comment Mark said like, well, I'm a very good customer of yours or whatever. And Google and Microsoft are both saying how much they're spending on AI. And you're 100% right. NVIDIA is going to crush it. I like this setup a lot more than if NVIDIA was mooning into the earnings, right?
I agree.
But we don't have NVIDIA's earnings until August 28th.
I was going to say, it's a late reporter.
It's a long time away.
Yeah. So just sit to the volatility.
10-year yield fell below 4% today for the first time since February 1st.
Wow.
Let's put this chart up. I guess this is what you would expect. Number one, on the front end, we know that the next move in rates is lower. The Fed all but guaranteed it. And then two, the economic data is now continuously surprising to the downside. How could the 10-year possibly hold up in the face of that?
And the 2-year as well.
Yeah. There's a few truisms in our business. And the first one is the 10-year is set by the market and the short end set by the Fed. And the 10-year is telling you the economy is weakening.
So the chorus of people saying to get out of cash earlier this summer, of which we were very much a part of, that was the right call. And hopefully people listened. money markets are, not going to roll over in price. You're just not going to love when they're yielding 4.5%.
Unless
when you thought it was 5.25.
Unless stocks are getting killed, you're going to like it real good.
Well, then you'll like it. Then you'll like it a lot. Did you see anything in the bond ETF world?
Totally.
Yeah.
You brought up a good point. But money markets, they tend to be a little bit slower. But if you look at the cash type ETFs, Bill, which is a 1 to 3 year Treasury, SGOV, massive outflows from yesterday. So you're kind of seeing that happening.
People are getting the message.
Getting it. They're either piling, if they're staying in bonds, they went into ag, they went a little bit into TLT, which is the really long duration treasury. But you're definitely seeing the money move out of cash.
But also,
right
when
now.
you say they, a lot of the they is model portfolios.
Models, I think that some products tend to be more like TLT. I think is pretty institutional, but yeah, a lot of it could be models as well. They're kind of they'll use Bill as
so a model portfolio being overseen by a CIO. They might say, okay, 30% of our fixed income allocation is sitting in SHY or sitting in Bill or something like really short term. What we want to do now is lengthen that out. And so will you see in the data money go into like IEI, which I think is a 3 to 7 year,
Definitely.
IEF is the 7 to 10 year. You'll see that?
Yeah, yeah. There's a couple that really stick out. IEI is one. IEF is 7 to 10 year. Those are the ones that we know that models use them. So they're the ones they're always constantly looking for.
So this is not retail. This is wealth management / TAMP / institutions.
Yeah. It's not to demean the retail investor.
No.
A lot of them don't know what IEF is. If someone was to mention what that, they wouldn't know it's a 7 to 10
How does this
year.
work? Correct me if I'm wrong. It feels like the BlackRock fixed income ETFs are like the ETFs for fixed income models. For some reason, Vanguard didn't really catch on as much in that space. How does something like that happen?
Yeah, they were first. They got the liquidity. That matters a lot. Meaning the secondary market liquidity. So they see the volume on it. They want to buy it. Just also the support you get through BlackRock, right? They
calling them up.
Their cap markets desk. They've got the Aladdin platform. It's just, even on the Bloomberg terminal, most of the stats you want to run are going to be iShares ETFs. So they were first to do it. One other thing I think who really missed the boat here.
But does Vanguard have those duration bucket ETFs?
They don't slice it up. Like if you want a total market
that's
bond
part of the
ETF,
answer too.
but you could buy long duration Vanguard like EDV, but just there is this synonymous relationship with iShares bonds and like institutional. You're just going to go there. Like Bill, for example, is a State Street product. So there's a couple of pockets, but for the most part, they have like 65% of the market share in bonds is iShares.
And BND is still a big fund though.
Yeah,
Vanguard's BND is gigantic. That's the ag.
That's the ag, and that's just mostly for target date funds, stuff like that. It's being used for.
So I think iShares very wisely did those slices because if you're an institution and you want to express a view, buying the ag or BND is not going to get it done for you. So of course you could use regular bonds, you could use an active manager, or you can just have this suite of, hey, I want 3 to 7 year instead of 7 to 10. Why? Well, it's just my opinion. That's where I want to be. People want to do that stuff. Professionals want to do that stuff.
I want to ask you guys a question. So the reason why stocks are falling today is because the data is weakening, right? Like we got bad data, stocks tanked, yields tanked. If the Fed cut yesterday, how do you think stocks would have reacted to today's soft data?
It would have been bad yesterday because that would say the Fed, for once in their life, they actually saw something that we hadn't seen.
You think that would be the takeaway?
There was no reason for them to cut yesterday, except if they were, to your point, you were looking forward, kind of trying to look around a corner and say, I think they should cut now. Right.
Well, I also said it in March, so
I think the market would have ripped yesterday. You're thinking that investors would have said, "Why are they cutting?"
Yeah, why are they? Because
we'll never know.
Powell has been so scripted, in his own script about wanting to see the data, and so they changed the words. Right, like now they see unemployment. We see unemployment, and now the Psalm rule, the woman that put together.
She's so hot right now.
I know, right?
Claudia Psalm.
Right,
She's on the name on everyone's lips.
Heard of her 3 months ago, but now that's what we're all waiting for.
Well, because what Claudia Psalm devised, and she'll tell you herself, it's not like foolproof, but she devised this way of looking at backward-looking data, which unemployment is.
Yep.
But coming up with a way to speed it up and show you what the more recent trend is versus the larger trend, and almost give you like an early warning system. And
when it moves up 0.5%, right, 0.5, which it's moved up 0.4, right, then that has been a very good predictor of a recession. But I mean, it doesn't feel like we're in a recession. It doesn't seem going into this election cycle. We're going to go into a recession.
So we have non-farm payrolls tomorrow.
Wait, can we do this chart with the FOMC start time. I always find this interesting. So the gap going into it, and then just like parsing through what happens after. That's all algorithms, right?
Mm-hmm.
That's not people making decisions based on a press conference.
I was trading.
Was that you?
It was algorithms plus Michael.
But it's pretty powerful.
It is.
You have software programs that are written to detect a change in the language in the statement, and they just go.
Yep.
And some of them will be right, and some of them are betting the other way, they'll be wrong. But we should not interpret that necessarily as like regular people being like, hey, what does that mean? It's not till later.
It's not. Exactly.
Yeah. Maybe even the next day. So maybe that's what today is about, in addition to the weaker data. It's just people being like, wait, they should have cut. They're behind the curve.
But ultimately, it's like earnings for large cap at least
Good.
have been really strong.
Yeah.
Earnings for small cap, not so much, whatever. But earnings for large cap has been really, really positive. I'm sure Apple and Amazon will also have good numbers. And so if you just like kind of, sometimes you just ignore this economic noise, because it is just noise, that earnings are good. We'll see what happens with unemployment. We're not at 5%. We're at what? 4? 3,
We're gonna
9?
get Apple and
Yeah.
Amazon in about 40 minutes. Well,
Yeah.
Apple's late, but that's the only thing that could stop this probably right now. What do you think?
You know what other indicator I wanted to throw in that we always look at? SPY volume. It's not when it jumps up, it really kind of shows a freak out. I don't think SPY volume's jumping that much today. It seems pretty normal. So we always like to look at, because just SPY is such a behemoth, right? And how much it trades. It doesn't seem like it's freaking out like it
Neither
did
was the
a year
VIX.
ago. It's so.
It's not even at 20.
I know it's not highly technical, but the SPY volume I think is a pretty interesting indicator of when the market really starts to freak out.
You know who does good work on this? Warren Pies looks at volume and inverse ETFs as a percentage of total trading volume.
Yeah.
You ever look at anything
Yeah,
like
we
that?
do. And it's definitely, it's still pretty, it's not extremely bullish, but it's still on the bullish end. We run a similar indicator.
What does bullish mean? That people are,
They're trading the leverage long stuff more than the leverage short
and you think
stuff.
that's like confirmation bullish?
Yes. And you know what else I thought was interesting? So if you look at the top, which was the 15th or 16th, people weren't piling the inverse ETFs. Like that, usually that should jump up a little bit. It hasn't, right? If anything, they were
When
buying.
you make a new high, you mean people should be jumping into the.
Or let's say during that downtrend, say from the top,
Okay.
you should see more pickup in the inverses. If anything, people were probably piling into the longs as more of a buy the dip. You saw the Soxel, which is 3x levered semis. They're going the other way. So it seemed like it was more dip buying.
Semi's
than-
got annihilated.
Soxel
today.
is down 23% today.
What is that's
Today.
3x semiconductors?
Yes. Today.
Who
That's
needs
crazy.
this?
There any tourist capital. There's a lot of tourist capital in the market, right? The zero date options, all that stuff, all the levered one day Nvidia long
how
that
much
gets
of that-
washed out, which is a good thing, right? Because having Nvidia go up when it's split, go from 100 to 130, which is 1,000 to 1,300. That's crazy,
Yeah.
right? It just kept just
If I
feeding
tell
on
you the
itself.
numbers in dollars, it sounds even more crazy.
like
Like
the
market
trillions,
cap,
like
yeah.
2 trillion to 3
we shouldn't-
trillion.
Yeah, I don't think a company fundamentally
Right.
could do anything that would enable it to go from 2 to 3 trillion.
Correct.
So it's only sentiment at that point. Unless you tell me like NVIDIA researchers utilizing AI, like literally just cured all forms of cancer, it's completely unjustified. Now, if you're long, you're like, shut up, Josh. Let it keep doing that. But I think most people were, even NVIDIA bulls, were saying like, this is too much. Like it's
Yeah.
great. Thankfully,
Yeah.
I own it, but like it's too much. And it turned out it was too much. So
Yeah, 100. I sold calls when it was there. It's like the call premium in Nvidia, a Tesla Nvidia, is so big, and so as an investor, if you have a position, you can sell calls on part of that position. You have to be willing to say, "I'll part with it at 150 or whatever your price is." But in Nvidia right now, that call premium, you're getting probably 6% in call premium for the October.
which is not even that.
1/3
Which is not even
it's
that
like
far out.
76 days.
Yeah.
6%. If you annualize that, that's like 24%.
Yeah.
John, chart 1-3. Let's talk about equities and yields on Fed Day. So for the last couple of Fed days, you had the Russell 2000, 3 of the last 4, looks like 5 of the last 7 or 5 of the last 6, outperforming S&P 500 as yields fell. Clearly, the Russell 2000 is more sensitive to interest rates. And there's been
And the economy.
on the economy. And there's been a lot of upside and today downside volatility. And it's a factor of not just what the Fed says, but also like, it's very sensitive to economic data.
Wait. So what does this mean? This is the 1 day change of equities and
It's
yields
on
on
that
the
day.
FOMC day.
On that day.
Okay. And what's the message from Wednesday of this week relative to prior? Was it more or less of a
The
move?
Russell 2000 actually underperformed the S&P, but it had outperformed like in a dramatic fashion over the last 2 weeks. So who knows how much of that is noise? But you're not a believer in small cap stocks.
Not right now. I mean, we went into small caps in fourth quarter of 2020, but not. I think I'm a non-believer in the Russell 2000. We went into a small cap value factor base that gets rid of the crap.
junk.
Here's the deal, which I think you have to like understand these like longer term structural shifts. There's that chart. Is that within small cap, just as of March 31st, and I'm a huge fan of Jim Grant, so I read comes in the mail. I get an email, but he had a great write-up on small caps a couple weeks ago, his team. Is that through March 31st, just 3 quick data points. Operating margins for the Russell 2000 were 4.7.
Not great.
The S&P was 13.7, okay? In addition, Russell components are set to report a 5.6 decline versus the S&P expected to do a 9.3 beat. On top of this to me is like on a 12-month rolling basis, 42% of Russell members lose money. Contrast that to the beginning of 2000, the beginning of the millennium, you only had 20%. And then if I go to the very bottom thought that I have is that there's no IPOs. And when you do have IPOs, they're not IPOing into the small cap. So you had Amazon was a small cap. If you go back, there were a lot of companies that started as small caps. Look at Reddit. Reddit started at $6.5 billion. I think it's 10. The average market cap within the Russell 2000 is $3 to $4.5 billion. And so I think you have this these are decreasing small operating margins. 40% are not profitable. IPOs aren't IPOing at small cap.
A generation ago, Airbnb and Uber would have started in the Russell 2000.
Yep.
They would have gone public worth a few $100 million each, like honestly.
Right.
And now the counter to that is, but they were losing money, so it wouldn't have, they would have been in the Russell, not the small cap 600, and nobody would have owned them. Maybe.
Well, I mean, 40, they would be a good company because right now 42% of the Russell is losing money. And so what happens is, to me, is like the Russell 2000s is like where companies have gone to die because you had super micro and micro strategy, right? Get booted uplisted.
Oh, that's such a good question.
And so,
we should have Sean or Chart Kid look at this. Like, how many members of the Russell fell into it versus were born into it? Mm-hmm. And what is that number doing over time? What do you think it is?
No, that's a good stat. I don't know. And just the thing about the small cap indices, they're almost like the deck is stacked against you. Because to your point, the star players leave, right? Mm-hmm. And then you're stuck with the junk that gets downgraded from the mid cap or the large cap. And that super microcomputer is such a great comment because we looked at it. We looked at Russell performance. This could be a blessing or a curse, but because it kicked out super microcomputer and MicroStrategy.
Mm-hmm.
But they were the best performers.
They were. But now with this kind of AI unwind, if they had kept it, the Russell would have been almost 3% worse than what it is now if they had kept those stocks. Mm-hmm. Now, granted, there's so many other stocks in it, but super microcomputer was such a massive weight. It was the largest weight that any company has ever had.
It was driving the whole index's returns.
So it got like to almost a 3% weight, which is unbelievable in the Russell 2000.
Is Russell 2000, is IWM the largest ETF in small cap land?
Yeah, it is. It's between that and IGR. It might be pretty large too, but those are the two big ones. IWM from iShares says,
what's more ridiculous, bucketing stocks by value versus growth or bucketing stocks by market cap?
Yeah, they're
well, with the exception of the S&P, right? The Qs in
that's just the biggest.
The Qs in the that's market cap. That's what I'm saying.
Yeah.
The Qs in the S&P aside, yes, I think.
But how else would you bucket them? By alphabet?
Weight?
What if you didn't? What if you just said I have a cutoff? I don't invest in sub 5 billion, and I don't bucket anything. And if I hold a mid cap and it graduates into the S&P,
okay.
It doesn't matter that I run a mid-cap fund. I'm keeping the stock.
Correct.
I still like it.
I agree.
There should be more of that and less of the, we have to fit into Morningstar's classification or else we're not going to get selected for the mandate, which is, I think, where this all came from, right?
Look through all the different index providers. Everyone's going to have super microcomputer different. Some might be large, some might be mid, some might be small. So it depends. Do you like MSCI? Do you like Russell? Do you like S&P? They don't always see eye to eye on the companies, right? And so there's not a set that, okay, the market has agreed that this is the cutoff. Everyone's got their own cutoff.
Yeah, I think it's about 17 or 18 billion dollars are the smallest S&P 500 names.
Yeah.
Wow.
So the Russell 1000 is all large caps, but the S&P 500 is the largest of those large caps. My attitude is I'm sort of cap agnostic myself, but of course, like every portfolio is going to have more stocks that are big versus more stocks that are small, unless you're a professional small cap manager. Because you're just going to end up holding your winners, and your winners are going to become large cap.
A counterpoint to the Russell 2000 stinking, not just that index, but just small caps in general, is that they're valued as such. So it doesn't have to take a whole lot for any sort of re-rating to send them a lot higher.
I think though it's like the play, to me, the fat pitch is to buy small caps, not Russell 2000. There's a bazillion ETFs that have a brain, we'll say, and kind of do it more thoughtfully in a downturn. Right? Because we're going to come out of the downturn.
In an economic
downturn. Because these companies are companies of America. They have no global exposure. And so that's when you want to buy when GDP is expanding, when unemployment's already high. Okay. Or, because they're economically sensitive. And so I just think it's too early. And I think you have to thread the needle in the economy for small caps to work versus like either the equal weight S&P, that can do well. Other things can do well. But to me, small caps is somewhat of an asymmetric trade with more asymmetry on the downside.
So by the time the listeners are hearing this episode, we will already know what non-farm payrolls are. But just for fun.
No, people listen at 6.
Okay, fair. Tomorrow, July non-farm payrolls, 175,000 added jobs for the month of July. For reference, June was plus 206. The unemployment rate should be 4.1. If we add materially more than 175,000 jobs, does the market want that or not want that?
Oh, I don't know. I'll defer that to you.
Take a guess.
I want to have an economy that's doing well.
The market wants strong data. If NFP comes in weak, pending what Amazon and Apple say, the market's going to roll over.
So bad news is firmly bad.
Which I love. That's how the market should work.
Yeah. But we want good numbers because we don't have time for a recession.
We want good numbers. Amen.
Yeah. But back to the SOM rule thing. So we're at 249,000 initial claims. Like this is what they say is the trigger point. So I don't know. This feels like it only goes in one direction once it gets moving. But
the economy doesn't fall into a recession. It just doesn't randomly happen. There has to be either an exogenous event or the Fed, because the rates have been high for so long, and obviously in the regional banks have been acutely affected, commercial real estate acutely affected. But I don't think if the Fed cuts 1 or 2 times or waits or doesn't wait, that's going to cause the economy to go into recession. No, it's too late.
If it's going to, it's going to.
Right. So that's always where, to me, you always sound smarter when you're bearish, first of all. It's easy to be a bear. It's easy to look at all the bad data. But history will tell you the market goes up 77% of the time. Volatility is the price of admission. Know what you own. The tourist capital is getting flushed out. And just like buckle up and sit through it, because that's really been.
Don't put trades on that can't withstand more than one
one bad day
or one scenario. Let's put this market implies 3 cuts in 2024. I don't know when they're going to do these cuts. We're like running out of opportunities. So you have September, November, December. Nothing in August. They're fishing in Wyoming, and. Do they want to do a cut the day before the election?
I don't think it's the day before. I think it's after the election. I think it's the day after.
We should probably. I should probably look.
I'm
that
pretty
up
sure
it's
the day after.
All right, so maybe they can get away with doing that. Is that what you think? 3 cuts?
Sure.
I think so.
I'm not. I'm not passionate about it. I don't know, but I do know.
What if I tell you one of these could be a 50 basis point cut? You know how I know it could be?
Yeah.
Because they said it can't be yesterday.
Just like they said, we don't envision. I have this picture that I kept that from Jay Powell. He's like, we don't envision any 75 basis point rate hikes, and then they did 3 in a row.
Yeah.
So that's what I'm saying. We have to be open to the negative scenario that they've only engineered a soft landing about 10% of the time. It could be this 10%.
Right. If he's data dependent, of course there are 50 basis point cuts on the table. What are we talking about? Like if things deteriorate more rapidly, right now it's normalization. That's the word that, how many times did you hear that word yesterday? Normalize. So like that's fine. And then anything past normalization, they'll do anything.
If they cut in September, there's no reason to believe that they wouldn't go in November, December as well. That'd be weird.
Fair.
They do a cycle. Because if you think about PCE, which is what we talk about CPI, but Chairman Powell always talks about PCE. I've never heard him mention CPI. PCE is his inflation. Is it what, 2.6? And so we have Fed funds at 5.2. That makes no sense.
Yeah.
And so there's a ton of bandwidth. And historically, when they start the rate cycles, they're not doing one cut. And so I think if they start in September and we still have a decent economy, that's going to be really positive because we know we have over 250 basis points of wiggle room. And so they could do 100 basis points over 3 to 5 meetings. And you're still well above what that PCE number is. And so I think that could easily be positive. The Fed has a ton of room, and that gives the market some breathing room to their point, normalize things.
I like the normalization idea. There's something in between like roaring bull market and recession, and that's just normal.
Just normal.
God forbid we get a year like that. I think
and we would like to have the visible hand of the Fed out of the market and have them be neutral, but they haven't been neutral. They've been starting in 2022 up until now, all we talk about every other month is the Fed. There were periods of time when we were just not talking about the Fed.
Companies too. I saw a chart from Bloomberg. The number of mentions of the Fed in earnings calls is at an all-time high.
Mm-hmm.
A lot of companies are like, hey, come on, we're waiting.
Do the cuts. Do the thing. Do the thing. All right, can we do some index stuff and the tech unwind? Because this is really, other than FOMC, this is really
That's what people came for.
This is like one of the biggest stories, I think, of the summer. And a month ago, it seemed like this could not happen.
Mm-hmm.
There was just money pouring into tech you couldn't even have a down day. It got to the point where a flat day felt like a down day. All right, so this is not that. What's this first chart?
So we're looking at the drawdown of NVIDIA, and there was this idea, not entirely untrue, that the tech trade was holding up the market, NVIDIA specifically, and if NVIDIA goes, watch out below. And it's a little bit premature to say that won't happen, but I'll say that right now, NVIDIA is in a 19% drawdown, got as bad as 24%. The cap-weighted S&P was only down 4%, and alongside that, the equal weight was only down 1.4%. Next chart shows something similar. We're looking at the drawdown of the S&P 500 in blue, down 2.5%.
Which is literally nothing, by the way.
Nothing.
Okay.
The average drawdown, not by market cap, so the average stock is 17.7% away from its 52-week high. If you look at the median's drawdown, it's better, which has not happened in a long time. The median stock is only down 14% from its 52-week high. And what this is showing in some sort of confusing way is that the rally is broadening out. So for all the money coming out of NVIDIA, a lot of the rest of the market is picking up the slack big time, which is like really healthy rotation.
It is. I mean, we have in our portfolio 2 big ETF positions, RSP, which we added in January, as a mean reversion trade. It hasn't really mean reverted. It has a sniff of mean reverting. And then we
RSP is the equal weighted ETF.
Right? And and so you had the biggest dispersion since 1998. So it's like it always comes back, whether the S&P comes down or it comes up. Hopefully it comes up with the S&P. And then we have a free cash flow yield ETF. And you've seen, although the Russell had a big, whoosh on the upside, those have also, to your point, had really nice day, with the exception of today, really nice days. And so that broadening out, I see that, across these 2 ETFs have nothing to do with it.
I love it.
The media forgets, though, sometimes that there's something
There's
else.
other stocks.
It's not just Russell 2000 and Mag 7.
Yeah.
There's like another 1,000 stocks we're talking about, right?
This is the most bullish sell-off I think we've seen in a long time. But it's doing, now that the big caps are so gigantic, it's doing this really weird thing to the market. Bespoke has a chart where they show the days over the last 50 days where price and breadth move in opposite directions, which usually doesn't happen. Right? They usually confirm one another. And it's at as high as it's been since 1990. And again, we're looking at price of the index versus the number of stocks going up or down.
What should normally happen? As price goes up, the number of stocks should also go up.
If the market's up 1%, more than 50% of stocks should be up on the day.
Yeah.
And now we're in a weird position where you're having a lot of, prior to the most recent couple of weeks, you had a lot of stocks go down, the RSP go down, but big cap tech was making the price-weighted or the cap-weighted index go up. And now we're seeing the opposite side of that, where the cap-weighted index is going down, but there's more stocks participating, which is phenomenal, I think.
Are flows going into these equal weight vehicles?
Yeah, oh, big time.
Big
There's
time.
a lot of RSP buying. There's also a lot of market cap buying. But
Answer this. I was talking with Ben and then James weighed in this morning. How is it possible? You guys have done a lot of work on this. In July, VOO has already set the record.
I know.
For in a calendar year, most inflows ever. And I think IVV is doing the same thing. Why? Like where? How?
Yeah. I have a couple theories, but I also have a lot of mind-blowing stats. This is the best July ever for flows. Second best month ever.
Equity
for
flows or
Yeah,
all flows?
Best month for fixed
Ever.
income ever.
So that's
July.
get out of cash. People are doing that.
And this never happens in July. July's always a quiet month.
Yeah.
People are on vacation. The VOO thing is interesting. I think it's a lot of just retail asset allocating to that. I think there's a little bit of a wonky industry thing that Vanguard is transferring people from their mutual fund to their ETF.
Oh, that's gotta be
there
it.
you go.
That's
So I
gotta
think
be it.
that is a part of it. So it could be a little bit.
Wait, how do they do that?
So it actually, it's a very unique thing. If you want to get
I know
into
the ETF is considered a share class in the mutual fund, but how do they physically do that? They call people up?
Yes, and because if you go on their website, you can do a free transfer from the mutual fund to the ETF, and so they're pushing people to go towards.
Why
the
are they
ETF.
doing that?
Without
Why is
tax,
it-
without tax
Yeah,
ramifications?
without tax. Because it's the same pool of assets. You're just like, do you want it to?
No, why do they want that to happen?
This is
why
a
does
theory.
Vanguard want that to happen?
So one thing that we talk this with Eric Balchunas all the time. Vanguard's not known for their customer service, right? They don't make a lot of money. They're not investing a lot in tech. So if you are buying a Vanguard mutual fund, you have to deal with Vanguard.
Yeah.
But guess what? If you own a Vanguard ETF, you are Schwab's problem. You are E-Trade's problem. You are
The
Robinhood's problem.
custodian's problem.
And I get it. Why not push?
Right.
It's the same thing. Push that over to them. We don't have the bandwidth to handle
Is this new?
this. It's been happening for a while. I'm not saying that's the reason.
It's not the new CEO, though.
I'll say that's
Oh
the
no,
reason.
he
It's
just started.
It's the only thing that explains this.
If you look at Vanguard index fund flows, they're negative from that. So why would you be selling the index Vanguard mutual fund right into this
What do
market?
you think? What do you think?
they're just
What do you think
moving
the
people
pitch is to the shareholder? Like, hey, you own our mutual fund. It's just as cheap to be in the ETF, but maybe more
In a-
tax
yeah.
efficient.
That's what the cost basis transfers over to.
Yeah,
That's
because it's the
pretty
same. It's a
Yeah.
very unique thing
Yeah.
because they have the share class option, but really, all being equal, you should favor the ETF.
Right.
Like it just has a slightly better tax
Yeah,
edge.
that's the same thing.
But exactly the
no,
same thing.
No,
intraday liquidity.
Right.
Not that.
But
not
I
that
think a lot of the
uses
Vanguard people
that,
don't. They don't
but-
necessarily maybe care about that. But
Yeah.
I think you're fine with VOO. You know,
Interesting.
and
Okay, so it's actually so it sounds like it's customer friendly, and also it's less intensive on the back office. 1940 Act funds require tons of like processing and people moving papers from one side of their desk to the other.
So you know
There's a
what it
lot
could
of
be?
shit in the background.
It's not money coming out of money market funds, but it's money coming out of BIL. Is the data showing that? Is money coming?
I thought so too. It's funny. I was just having this conversation. We were looking at the flows. I'm like, where's the money coming from? They're starting to, the money market stuff, the ETFs are starting to come down, but not in a massive wave. Like that explains, is it just new money coming to the market? Is it coming from active funds?
Yeah.
I don't know. Because yes, we talked about this small cap rotation, but there was a lot of large cap buying too. Like the Q's took in a lot of money, RSP's taking a lot of money. So it's not that being sold to buy IWM. It just seems like there's this whole new flow.
It's like a
of money.
magic pot of money. I don't know
Where's
where
it
it's coming
coming
We
from?
had
I don't know.
we had Todd Sohn on 2 weeks ago, and he said actually the money never leaves money market funds. The inflows slow down, but they continue. And good market, bad market, good economy, bad economy. Money market funds just continuously vacuum up money no matter what. So that's not the answer. Is the point?
No, I agree.
I think a reasonable guess is that it just could be as simple as people have earned a lot of money on their money for the last year and change now, and maybe not all of it was allocated to money market funds. So you don't actually need to see it leave anywhere. It could just be sitting in cash. I mean, I don't know. I'm trying to figure it out myself. But
There's one thing that I also thought maybe too is some foreign buying. It seems like a lot of at least in Europe, we'll look at it, they seem to be buying U.S. stocks. So whether they're going through ETFs or funds, could also be maybe some foreign money coming in.
But this has
And that's
been a
hard
big,
to
big
track.
topic of debate.
besides Bryn,
Yes, for sure.
besides Bryn, who else is putting on these equal weight ETF trades? Do you think
I
Is
think
this-
models are.
models are
and
okay?
For the same reason, right? There's a big
exactly.
dispersion.
Just
Yeah.
it's maybe going to that. Is that the new hedge versus buying the inverse? Are you just are you hedging away from the Mag 7, right?
Okay.
And why I love
Oh,
covering
you're saying I
ETF
want to be in stocks and I want to be in indexes. I don't want to be 12% Nvidia.
Yeah,
Okay.
I-
So that's
so-
reasonable to
Yeah,
me.
I don't want 30% of my portfolio to be in four names.
totally.
You know what's interesting?
And by the way, it's been a good trade.
It's done okay.
So far.
It's done okay.
And
Yeah.
It's not
why you have to
outperforming the
love
S&P,
the
but-
ETF industry. This just filed yesterday. There is a 493 ETF that filed. XMAG 7.
I love it.
So
What took
it
so
was
long?
Defiance. So
Okay.
there you go. Like that's why the market will find a way.
The Defiance guys are,
Yeah, and
are
they're
pretty,
calling it the 493. And we
clever.
joke like we need a 493 S&P ETF, and there you go.
It'd be funny if people start tracking, if people start using that as a shorthand for equal weight. It's probably not equal weight. It's market cap weighted
Yeah, I
minus
think
the top
so.
7.
Yeah. I doubt it'll dislodge RSP, but I think
No,
it's
a
an
different,
interesting.
It's a different idea.
It's a great sentiment gauge for
It's
I
weird
think
that RSP is the only one that I know of. Is there? There must be another.
there's a
but-
Goldman one,
Oh, yeah.
GSEW, but RSP is just so. Once you kind of everyone knows the ticker now.
Yeah.
Once you sort of get past that,
Is that Invesco?
It
yeah.
is, yeah.
It was actually a Guggenheim product that they inherited. So it's funny that they sort of bought Guggenheim and they got that.
I
And
think
it's
I
a winner.
spoke about this. What does the ticker stand for? I think somebody told me that story.
Which ticker?
RSP.
I should know that.
I don't. Yeah, I think it might be something legacy from Guggenheim.
I can ask
should know,
my
but I don't.
AI assistant.
Because it makes it should be like some SPEQ or something.
Yeah.
Not
And there's equal weight.
It stands for
Qs,
random stock
Stock
prices.
portfolio, random stock.
portfolio.
Maybe it could.
I don't know what it's. Oh, Ridex. I do know.
Oh,
that right?
Right.
That's
Yeah,
how
yeah,
f***ing
Told
old
you
I
in
am.
your
yes,
ear.
yes,
Yeah.
yes,
You
You
yes,
know how
yes,
old
yes.
I am? I used to recommend it. I used to recommend it when it was called Ridex,
Yeah,
and
yeah.
it was
Yeah.
an open-end mutual fund.
Yep.
And I used to recommend this to risk-averse people that wanted stock exposure. And the pitch was,
There
tell
you
me
go.
how stupid this is. You were a broker too, so you
I
respect.
was.
The pitch was, do you realize that on any given day, and you would point to whatever stock just blew up that day. So you'd point to like
Stratacom.
Merck. Like, look at Merck just blew up because whatever their drug was, Celebrex did like.
Yeah.
So you would say to somebody, what if I told you that I could minimize the damage to your portfolio by making sure that you don't own more than 0.25% of every stock?
Go
They're
on.
like, so I won't own Merck? No, you will. You'll own so little of it, you won't even notice. And they like loved that.
It's true though.
First of all, well, I never bullshitted
Yeah.
anyone, but
Right,
like,
it
it
is-
was true.
Yeah.
It didn't exactly like work
Right.
versus the S&P.
To that
Right.
point, Josh, of things blowing up, there's almost 20 stocks that are down 8% today in the S&P. A lot of them are semiconductors.
Yeah.
Micron and AMD, Micron's down 37% from its high. It's a lot. AMD's down 34%. Like
Yeah.
it's a lot.
That's why you need
And the
That's
volatility
why you need
though,
Ridex.
right? That's why you need our.
That's some deep
Today's
knowledge.
show is brought to you by
That's some deep ETF knowledge. That's all.
You remember Ridex?
Yes.
Okay. Rob and I are like the Muppet Show characters, the two old guys in the balcony. what are those?
Statler and Waldorf.
Statler
Yeah.
and Waldorf.
I can be
that's me.
Janice.
What's that?
I'm Janice.
The two old guys that heckle the Muppet Show.
Oh, that's
a
a
name?
By the way, how much are we dating ourselves by talking about the Muppet
Muppets.
Show?
Yeah.
Roll.
Best show ever. Best show ever.
Best show ever. You're my generation, right?
I can be Janice.
Okay.
I'm up at
Perfect.
100%.
You could be Janice was the girl singer
The rock
in
and
the
roll,
band.
right? Yeah.
Bryn,
Right.
we've got some of your charts. What do you want to talk about with QT? What do you think is the significance of the wind down of the Fed's assets?
You know what? I just think it's interesting because for all of the, I mean, when as QT has ramped up, obviously from 4 trillion to a peak of 8 or almost 9
QE.
QE, right?
Wasn't it supposed to be bearish? Finish your thought. I'm sorry.
Yeah, so I think also just like some interesting numbers, we don't have the ability typically to understand quickly the difference between $1 billion and $1 trillion, and we kind of just like a trillion
same thing,
here.
right?
But if you think about this is good. 1 billion seconds is 32 years. 1 trillion seconds is 32,000
Yeah, it's
years. There's a
crazy.
huge difference between.
Oh wow.
So it's huge. So these trillions of dollars, I would have thought that the QT, the unwind, would have had more of an impact on the bond market.
Why? Because it's sucking liquidity out.
Yeah, it's sucking liquidity out. We've
Yeah.
never done it before.
Yeah.
Right. And so it's interesting that I haven't seen an impact in equities. I haven't seen an impact in bonds. And they've brought it down from, I think, 9 trillion was the peak to 7.2. So it's just so interesting. I would have thought that would have really wreaked havoc. I guess in like the reverse repo market, which I'm not versed enough. The Fed,
All this shit
the
is
Fed
so
took that
confusing.
over. But
I would say that this is one of the things.
Yeah.
The quantitative tightening was one of the things that was most scary to contemplate.
yes.
When you hear all right, so the Fed took its balance sheet from 4 trillion up to 9 trillion in like 2 years. And now they're going to take all that liquidity back.
Yeah.
meaning they're going to stop buying bonds from Treasury,
Yeah.
and they might even start selling down their bond portfolio. On the surface, that sounds like, oh shit.
Yeah.
Not that it tanks the economy, but like it depresses multiples for everything.
Or just like
Stocks.
unintended consequences of
Yeah.
an experiment that we don't know what happens on the other side. And that's one of those things. I just think it's an interesting chart because sometimes bad things don't happen. And that's where it's like you always sound smarter when you're bearish. And so that's where I kind of go back to like at the end of the day, markets go up 3/4 of the time. And we're all waiting for the 20% that they go down.
There was no more obvious bear setup than this. And it just didn't happen, right? At the end of 22, you're like, all right, I guess we're doing this. And nope, guess we didn't.
Let's put up the next one, the rich get richer. What are we looking at here?
Well, so I think we already talked about these. These are all my small cap sides. So
Yeah.
we already went through all this when I was just walking through, obviously large
the
cap.
next one I want to do.
Mm-hmm.
NFIB, small business sales expectations. What's going on here?
It's definitely in recession territory. If you listen to like Winnebago, like these smaller companies like Winnebago sales aren't good. The consumer's pressured. Obviously, I think if you were to buy a Winnebago during COVID,
I'm sorry,
you get the reverse to that.
Winnebagos.
Well, no, this is a popular way to vacation all over America, Michael.
Yeah.
Don't you lecture me.
Well, if you get out a little bit, meet some people.
Actually, I was driving past Nickerson yesterday, and there's a Winnebago park.
Yeah,
Tons of Winnebagos.
So did you get out and talk to any of the people? You should hear what's going on. So this says that small business sales expectations. This is an index. What is this based on? A survey?
They do this is a June survey. They small private firms. It's the National Federation of Independent Businesses. And once again, it's like
the kind of people that Michael can't be bothered with.
Real companies.
Yeah, but you know why
America.
This is bullshit?
It's America.
Because this has been negative for like the last 5 years every time.
I think this is politically and personally.
Sure.
I think there's politics in this.
There could easily be.
Yeah.
But this has been has been negative every reading for the last 3.5 years.
This is all around small caps. This is all not about the broad economy. This is all in the flavor of small companies have felt the pain.
Totally.
And so when I talk about 42% of small caps have negative earnings, it's like this is the whole issue with these smaller companies that things are not great there.
But if you go down smaller than small caps and like real businesses that are owned
private
by
companies.
Yeah, just normal businesses. Like, okay, I have
Inflation
to pay.
is real.
I can't pay $11 an hour anymore. Now it's $15, and my borrowing costs are up like X-fold. Like they got killed.
Yeah, absolutely. So
we did this one. We mentioned this already, but let's just go to profits wanting. This is your percentage. I want people to see this that are watching on YouTube. The percentage of Russell 2000 companies that are negative net income is almost half.
I know.
That's crazy. I had no idea it was that bad.
And so in the once again in 99, if you think about it, you had a bunch of small companies IPOing, and you still had only 20%.
So what are these pieces of shit?
No, this is from the ZERP era. Like money was free, and so profits didn't matter.
And so when everyone's just so passionate about buying Russell 2000, I think it's kind of a depressing index when I look at the factual data behind the fundamentals. It's just like, why would you buy that? I guess if there's like a trade or what have you, but I think there's a much more thoughtful way to buy it.
With bonds, we used to call them fallen angels when they were investment grade credit and then they fell below a certain threshold.
There's an ETF for that.
There sure is.
The fallen angels
say that
ETF?
probably about anything.
What's it called?
Yeah, it's Angel, actually.
Angel.
Yeah, Angel.
But there's also an FALN.
But that's
that's iShares.
That's a legitimate investing strategy because what you're betting on is that, okay, things are bad for these companies, but it's not that bad that I'm not going to get my money back by the time the bonds
But that's
mature.
also like a structural value play because there's companies that can't, there's corporations or whatever, investments that can't own those bonds, so they have to sell them, depressing the price.
Right.
Like
There's another
artificially.
market for it.
Exactly.
So, but this sounds like it's the equity version, the modern Russell. These are companies that have fallen backward into the Russell because we're just not doing that many IPOs. And so they're like fallen angels, but on the equity side. Maybe these used to be mid-cap 400 and now they're small cap
I have an
600.
idea. You guys should do the work for us. Yeah. Your team should do the fallen angels and the Russell 2000.
Yeah, I mean, it's funny. I did have that question. Someone asked me they want the crappiest small cap stocks. Like just because maybe because they saw the rally.
Just go on Twitter.
They're like, I want the one. I don't want S&P 600 with the profitability screen. I want the trashiest crap that is
all the negative earnings. I want the 40%.
I want the 40%. Yeah.
Just give him a list of the IPOs from 2021.
Exactly.
That's pretty much what it is.
But on the, you know what never comes up though? No one ever asks about mid caps. And
Sure.
I don't know, you know, it's, we always talk about small, we always talk about large. I don't know, I'm just curious.
Yeah,
what
who
you
does?
think. No one
Elizabeth
ever
Banks.
asks. No
Remember
one,
that commercial?
Did they stop using her?
Yeah.
I think, but no one ever
State
asks
Street,
about it.
That was so awkward.
State Street hired Elizabeth Banks, who I love, to do a series of commercials celebrating mid caps, and it's before the Gen Zs were using the term mid, so it kind of missed its moment.
Dude, this is like 2014. This is like literally 10 years ago.
I know, but if they would have done it now, I'm saying they could have really leaned into like
To the mid, like
they're mid caps, but they're not mid.
yeah,
Like,
nothing mid about mid caps. Like,
all right, so that was super weird. I don't know who greenlit that that series of commercials, but anyway, nobody talks about mid caps because they're kind of like they're two in between. I guess they're like Jan Brady.
There used to be, I haven't looked at the data in a long time, but I would say like 5 years ago when I looked at it, there was data that mid caps had been one of like the top asset classes because, you know, you've made it out. You've made it. You're super micro, what have you. You've made it out and you actually have profitability, et cetera. And so I haven't looked at the data, but I think it's just to your point, people like small caps or large caps as a sector. And then it's like Jan Brady.
I bet you this year it's a great hunting ground for some of the big winners of the year.
What's the
Mid-cap
ETF?
growth ETF.
MDY, which you're spot on. It's a great performer. It's just no one ever talks about it.
It used to look like RSP. They used to track each other pretty closely. So the biggest holding in MDY is Williams-Sonoma. We know that company.
Yeah.
So I bet that's a really great place to find stocks that have been working this year and could probably continue.
And don't get sucked up in the large cap stuff, you know, and there's sort of, so I agree.
I want to do more on the bond stuff that we were talking about earlier. So this is from the Journal. U.S. listed fixed income ETFs have taken in nearly $150 billion through late July. Another record through this point in the year. I just so much money. Chart on, please. So these are the monthly net flows for taxable fixed income. And this makes sense, right? People were like, we're getting ahead of rate cuts. That made total sense.
Wait, Michael, this says, hold on. This says, when looking at mutual funds and ETFs together, taxable bond funds were responsible for nearly 90% of net U.S. fund inflows in the first half. So 90 cents of every dollar that went into a fund this year went into a taxable bond fund?
But it's kind of crappy wording.
Okay.
No offense to Morningstar. It's of the bond flows, 90% went to taxable bonds versus munis, which I don't know why they break it down. Like, most of the money goes to taxable bonds anyways. Like
munis are tiny relative.
Yeah, so it's always like probably 80 to 90. But then I just mentioned too, because we just got the data today, equity bond ETFs record month ever, even more than when the Fed started their buying in 20.
Wait, what do you mean equity bond ETFs?
So bond. Did I say equity bonds? I just meant bonds.
Okay. Did you just invent a new asset class?
Equity bonds.
I'm interested.
I will buy some of these assets.
All right. It's so crazy to think about back to when interest rates bottomed and the price of all of these bonds peaked, how many bonds around the globe were negative yielding. So Todd Sohn has a great chart showing where rates were around the globe when the ag peaked in August 2020 versus where they are today. And nobody would argue that that was a better environment for bondholders than today.
No way.
Made no sense.
So this to me was one of the strangest parts of the 20-teens decade.
This might never happen again. And I know never say never, but like this was really fucking weird.
Yeah.
You had Swiss, like
trillions.
100-year Swiss bonds, right? One of the countries.
There was trillions of
At
sovereign debt that had a negative yield.
Yeah.
This is a combination of PTSD from the great financial crisis, like the hangover from that, and people saying, I don't even want any return. I just literally want my money back. And then that morphed into, actually, I'll pay the government just to hold my money. So that was weirdness. Yeah. But
that would never happen in America.
Well, you can't have that without the central banks being part of it. So they took rates to where they needed to be
in
order
weren't part
for
of
people
it.
to think that way.
They created it.
They created it.
They created it.
They were.
In hindsight, none of those economies benefited. I don't think any of them would do this again. Like Europe, you would think negative interest rates, money should flow to more productive use. No, it didn't.
Well, they got free money.
I think though you have to like take a step back. Those countries are like socialist capitalist, and so when you can't fire someone, that's a structural issue. When you have all of these services that the government pays for, just a whole different economy than the capitalist nature of America, that you have these structural issues that it's just different over there. And that's where I still think that the U.S. is like, why buy international? Just buy the S&P. You've got, 45% of your revenues are giving you exposure over there, but you can still fire someone if they need to be fired.
Another thing that made no sense at the time, John, next chart, please. We're looking at the yields of various ETFs then versus today. And you had the 1 to 3 year, the 3 to 7, and the 7 to 10 all yielding around 1%, give or take. Even TLT, which is 20 plus years, was yielding 1.3%. That was truly reward this risk. And so Todd compares the yields then versus today. And again, we're in a much healthier place.
Yeah.
Or you're in a much healthier place if you're buying them today. If you've held them, you're still negative.
True.
Because there's this little word called duration that you got your face ripped off if you were in the AGG the past 5 years.
Bond ETFs are taking in $1 billion or more in inflows per day this year.
It's a fight the Fed trade. But TLT for the last couple of years has been like a widowmaker. You've lost money on TLT.
Yeah.
Finally seems like it's starting to break out. But people have been trying to play the Fed meetings for 2 years now on TLT.
Have you ever seen money run into a fire like that? And it just kept getting lit on fire and just more money just kept coming in?
2022 was big for TLT. It was like the top 5 for flows, which is pretty.
And it was down 20-something%?
Yeah. It was every Fed meeting. Everyone rushed into it. Like, this is it. They got burned. They did it again. And everyone was like so confident in being able to read the Fed. Then you could see that stop. They're like, we're going to stop front running this. We're going to wait to see what they say. So you definitely see the tone change.
We have seen that. We saw it in Chinese internet stocks.
Oh, yeah.
K-Web raised money the whole way down. So that's counterintuitive from what we normally see. What we normally see is an asset class or a strategy goes up 100%, and then the investors come in with the big numbers. In this case, these things were falling knives, but they're part of human nature is to expect mean reversion or, hey, there were just 7 reds in a row on the roulette table. I'm betting black. So there's an element of that to it too. Like, how much more could this thing really fall?
Or it's like, you read the research for the first time and it's like, oh, well, this is cheap. I'm going to buy it here. And because it's your entry point, you think it's bottom, then it just keeps going lower.
Tom, what's going on with active ETFs?
They're back, but
different.
Different.
Okay.
It's not active in the way that we think it's like stock picking. There's not all. It's
not ARK.
No, it's a little bit. It's just a technicality. A lot of it's options type stuff, buffers, covered calls. So they're active in the way that they're managing these options positions, but it's pretty systematic. It's not, there's no ARKs.
It's a boomer candy. Who came up with that?
Eric did. Yeah, it's a great term.
What are these ETFs?
So a lot of them, most of them are using derivatives. So essentially what they're trying to do is cap your downside. And
buffer ETFs.
Buffer. So it's like a structured product.
Like Innovator or like
Innovator that.
So I call that systematic or active indexing. I do not consider that to be active management, but I guess somebody has to classify it.
I think it's just a technicality in the ETF rules. But it's not, all of a sudden stock picking's back and everyone's back to it's just they're using options around these. And it's just trying to come up with an outcome. So buffer is essentially like a structured product. You hold it for whatever period you want. Let's say if you want to buy it today, you're buying the August buffer. It's going to cap your downside up to a certain point, but then you're also giving up upside. So I get it. It makes sense for the boomers.
It stocks with guardrails.
Exactly.
Put this chart of active ETFs growing percent. You're saying a third of the money coming in to ETFs is coming into these quote unquote active ETFs.
Yep.
This is notable. Yeah. This is, by the way, this is like rain in the desert for the asset management industry. They need this so bad.
So they have to make money.
They have to make money somehow. I agree.
It's not can't all be Vanguard.
What's this next chart? What does this mean? Inflows, outflows. We call it the beta adjusted fee demarcation line.
Eric had come up with it, and it makes sense. It's about realizing how cheap beta, like a Vanguard 500 fund, is essentially free, right? So you have these active funds coming out. A lot of them are just closet indexers, and they're charging you 45, 50 basis points. You have to now take out beta, right? So you have something like ARK. Essentially, I don't want to pay for what I'm getting in the S&P 500. I want to pay for the uniqueness of the fund. So basically,
that's certainly unique.
Oh yeah, and people are willing to pay 75 basis points for it, right? But if you want to be closet indexing, which is fine, which is kind of like what DFA does, it better be a couple basis points, and that's it.
Gotcha.
And so it's just realizing that you are getting the market for free, Don't charge me to hold Apple and Nvidia. I have those.
So let me try to read this. Anything that would appear below the purple line, it means it would be more expensive than, let's say, 30 bips, and it would be.
It's basically based.
It would
on
be an
its active
outflows.
share.
You're losing money.
Basically, it's based on your active share. So how much are you charging me per unit of active share? So I just want charge me for the difference. Don't charge me for the stocks that I already own.
There are no customers for these funds. Because ETF. The only thing that matters for ETFs is what RIAs are doing. Yes or no?
Oh, they're a big part of it.
Like half.
Yeah, they're like half the market.
Okay.
Yeah.
So if RIAs have made the decision collectively because they all went to Future Proof and drank the same Kool-Aid, or they all went to Morningstar, whatever, if we decided as an industry, we're not spending 50 basis points to pay a stock picker in a sector in an ETF wrapper, then they're just not going to do it. So like there's no customer there. So you wouldn't launch a fund doing that. Buffer funds, RIAs would pay a ton of money for that because it answers a client concern. The client says, I want the stock market.
Not all of it.
Just not all of it.
And at the wirehouses, they do those in structured products. And I probably bet you could not buy those buffer
They hate
ETF.
they
You can't
hate
buy
ETFs.
them. You cannot buy the buffer ETFs at the wirehouses because it strips out all of the fees from the investment bank and makes a really nice, same strategy. It's the same exact strategy as a structured product at a wirehouse with downside. It's just with options and without all the fees.
Okay, here come the celebrity active ETFs. So I don't know, is this round 2? The Kathy Wood thing came and all right. So Tom Lee, our friend Tom Lee at Fundstrat is going to get into the active ETF game. So he has this thing, we talked about it on our show, granny shots, which is like really not layups, but like a really easy free throw shot underhanded by Rick Barry. And it's like stocks that I guess he and his team think are just easy trades to make. So I don't know what the methodology for the ETF will be, but they're filing. They're getting into the game.
Credit to him though. He's going to be.
I bet you he raises $3 to $4 billion in the first 6 months. What do you think about that?
I think that's a tall order, but I think it's going to be successful.
How big did ARK get at the peak? 15?
I think it's a different thing.
Do you know how famous and beloved Tom Lee is?
I get that with his Twitter following, he'll do it. So there's a couple. There's like Katie Stockton, right? She's got one. She's got a couple $100 million.
We love her too.
I think Tom Lee could do $1 billion. I still think that's ambitious, but he's got a big following.
Tom, maybe you didn't hear me. They're granny shots.
But
they're
also
guarantees.
I think what you're overplaying is people want to know what he's holding, but I'm not going to buy the ETF. That's just how I want to see what his portfolio is. Like the Jim Cramer one, right? It closed, but what I actually put my money in the Cramer ETF, I want to see what he's saying. So I think you'll have a lot of people that will follow the ETF, not necessarily a lot of people that are buying it.
Tom doesn't take advice from me, but if I were to give him advice, I would say pull the filing. Just do not do this. Because the reason why is not that I don't think it'll work. That's beside the point. On any given day that it's not working, or any given month that it underperforms the NASDAQ, or whatever bullshit, this is what people that are jealous of him are going to beat him over the head with. And it becomes your de facto track record. And so if you're going to be that in the public eye, I don't think you should have a daily ticker that's completely associated with you. Now, Tom's got a really thick skin. He's been taking shit from people on Wall Street for 15 years. He's been mostly right. He's made people a lot of money who've listened to him. And he seems to be having fun with his critics on Twitter. This is going to make it like 10 times worse. So if you're listening, it's not too late. It's not too late. I still think it'll be successful.
Yeah.
And
I think it'll do okay. I mean, kudos for putting your picks out there. It's not easy.
You want to be his investor relations guy?
And Rubini too. What's he going to own?
I mean, is he going to be bearish?
There's a ticker Doom.
Yeah, is it going to?
It'd be funny if it was like a Vanguard index fund.
There's one holding VOO.
Yeah.
It's going to be. I'm guessing. It says what did the notice say? He filed.
Go anywhere. I think it's a go anywhere strategy. Go anywhere,
also,
do anything, which to me
those,
is so nebulous.
Yeah.
I think that Tom and team have a track record. I know they do, right? They have a track record for those granny shots, and so I think I know there's a strong methodology around which companies go in and which companies go out, and these are like household names. The Rubini, who's not household name even remotely.
No chance.
Okay.
Also has been extraordinarily bearish and wrong for a very long time.
And so I think
he'll tell you he's been right, but like obviously not.
I think that it's so easy to structure a hedge in a portfolio these days that you don't need an ETF, which is limited anyway with like what you can do and like the leverage and the derivatives inside of there. I think a go anywhere portfolio doesn't have much.
So we were going to do this later in the show.
Hang on, before we move on to this, a lot of this depends on the market environment. If we roll over and we're in a 20% drawdown, nobody's getting inflows.
No, I agree.
So we were going to do this later in the show, but let's do it now because this is tied in. There is this thing where if you have a big enough Twitter following, you could probably launch a product.
Mm-hmm.
Bill Ackman thought that there might be enough demand to raise $25 billion. And then he said, actually more like 5 to 10. And then he said, you know what, I'm not doing it. And it was SPACy. It was a closed-end fund. So it was a bag of cash, basically. So if you give him $5 billion, he'll invest the $5 billion. Now, the problem is he already has a publicly traded vehicle for Pershing Square. It trades in Amsterdam, and it trades below its NAV. Mm-hmm. So why would you buy the IPO of Pershing Square in the U.S. at NAV when you know the history is ultimately this thing will end up at a discount?
He was saying it's going to trade at a premium.
Well, of course he was.
Everyone would be wanting to rush in to buy it.
Well, he has produced so to his credit, he's produced incredible returns. Nobody would say that he hasn't. Extremely volatile, great returns.
Mm-hmm.
So
not a closet indexer.
Not a closet indexer.
But if you look at the popular ETFs, they're like the everyday man's ETF. Like no one knows no one meaning like the average investor no one knows anything about his track record. But what people know with him on Twitter is his political views. And so to me, having a Twitter following of your stock portfolio or your ideas is one thing.
It's the worst idea I've ever heard.
Yeah. So I think that until the everyday investor, because I think what's tough about a hedge fund, right, which like I would classify his yoke of investing as like very activist, very specific, long, short, right? Concentrated is that as an advisor, that's so tough to explain when it's not going well.
No, because you're like, I don't know. This is a cult of personality thing. No advisor is allocating to this.
And so I think that's where you need the wirehouse buy-in, you need RIA buy-in, you need model buy-in. And I think that a strategy like that is a little tough to fit into any of those boxes.
What do you think if you're What do you think if you're a Pershing Square LP?
I don't think
he's like, I'm going to launch this thing where I'm going to invest for like the masses for, I don't know, 75 basis points. Are you like, wait, what? I'm paying you 2 and 20. What are you doing? You're doing a closed end?
Yeah. Who knows, right? I mean, I think he's done really well for investors over a long period of time, so they probably don't care.
Maybe they don't. Maybe
they don't care. It's like, you've crushed it for me.
All right.
That was really great. I think this will come as an ETF, though. I think you're going to see an ETF filing from that.
So he's not giving up, but the structure.
But I think to your point, it's hard to raise money in those.
The structure doesn't make sense. Closed end.
Yeah.
It makes sense because it gives him it's a fixed share count, and it gives him the latitude to do whatever he wants. Mm-hmm. Okay, fine. But there's no appetite for that because they know by the way, every closed end fund eventually trades at a discount. It's just the nature of what it is.
Yep.
So you think he can come back with an index strategy?
With an ETF. He's not going to get paid. You're not going to get payday like an IPO, but I could see it. I don't think he's going to raise any money. And we were talking about Twitter followings. The biggest one I know of, remember Portnoy during the whole craze of stock Buzz. He raised $500 million, and that was the most successful launch for something like that. That's why I think Tom Lee is going to underwhelm. And that was Portnoy, and he has all the degens and everyone.
But Tom Lee's followers have money.
But Tom Lee is followed by
a lot of
more
people.
investors,
Fair.
And Dave's following is just everybody.
But to want something that you were saying about unconstrained, no one wants to buy an unconstrained.
No, you don't know what you're getting.
No one wants to do that. They don't want to. I think they want to see what he's doing. I don't think they're going to give their money to him.
Hypothetically,
counterpoint. Nobody cares.
Yeah, exactly.
Hypothetically,
I think it's cool
though,
to see.
In an alternate universe, if he were able to launch and the thing did trade at a premium, you would see 10 of these right afterward, right?
Totally.
Right. Everyone that thinks they're better than Ackman would immediately file.
Like the club you can't get into.
Kudos for him for being innovative and trying to have a vertical
I don't hate
that can actually other investors that are not qualified purchasers can invest in. And so I think it's a great idea to have his strategy out to the masses. But to your point, I think the structure of closed ends not right. An ETF is a good idea, but he's not a household name with investors, and so
This is the last thing we're going to do today. I want to ask you guys about interval funds. Jason Zweig went nuts on these things last week. I thought it was a really tough article to read if you're an advisor that's currently recommending interval funds because it asks a question that it's really hard to give a good answer to. So basically, we know that financial advisors want to look different for their clients versus Vanguard. Okay, obviously. We also know that they want to seem more sophisticated than the RIA next door. And there are 15,000 RIA firms in this country. Private credit and private real estate are sophisticated asset classes. They are not available to the masses in an ETF, for example. So it requires some sophistication to even explain what it is to clients. But if you have the type of clients that are always like, what's next? Or what are you doing that's magical for me? These check those boxes. They're structured as interval funds for the retail market, which means you put money in and every 90 days you could take a certain amount of your money out if you want to, but like 5%. Very small.
No.
5%
If you're lucky.
5%
Of the fund.
of the fund.
Of the fund.
Yeah.
If you're lucky, you'll get like,
So you have daily liquidity on the way in,
yeah.
exit liquidity every 90 days.
Until everybody else wants it.
Okay, so it's an $80 billion asset class, the 100 largest interval funds that currently exist. There are, first of all, there's 100 of these. There were only 14 interval funds a decade ago with under $3 billion. So it's been a huge area for asset management. So Jason's take is, here's the problem. Number one, the illiquidity. But let's say you don't care about that. Number two, these funds are mostly leveraged. And they're not just billing you fees on the money you put in. They borrow up to a third. And then they bill you on the leverage
That
too.
part to me is crazy.
So I want to just read this real quick.
Right? They charge an expense ratio on the debt.
So this is Jason.
Yeah, seems
The prospectuses of several interval funds say their recent borrowings carry annual interest rates of almost 6% to more than 8.5%. Remember, they have to borrow the money, the fund itself. An interval fund that borrows 1/3 of its total assets could be adding somewhere between 2% and nearly 3% to its annual expenses. On top of that, some managers charge management fees of 1% or more on the borrowed money. All this can push an interval fund's total annual expenses towards 7%. Imagine a leveraged interval fund could buy a private loan with a yield of 12%. After all costs, barely 5% might be left for you. So the question in the article is, if that's all you're getting, why not just buy JNK? Like, why not just buy, like an ETF with leveraged loans or something? Why do the interval fund? And maybe there's a great answer and I don't know what it is.
Well, several things. I mean, we do a lot of private credit. We do a lot of private investments. And so to me, the problem is not the illiquidity, it's the liquidity.
Okay.
But there's no liquidity, but they're manufacturing liquidity. As long as other investors are coming in and they have some yield to kick off the portfolio, you can take your money out. But we all know with BREIT, when everyone wants to come out at once, these underlying assets are not liquid. And so if you think about it, a real private credit strategy, first of all, you ask, what is the strategy? So I think if one is just talking about the structure, that's problem number one. You should be talking to your clients about, what are you trying to solve for? What are you solving for? And if you're solving for something that needs a yield, the risk-free rate is the risk-free rate. So the 10 years at 4, the short ends at 5. If you want to get over that, you got to take risk. So J and K, once again, you're at all-time lows, so that could be risky.
You're not getting paid much for that.
You're not getting paid much.
Right.
But so on the private side, here's it goes. Let's say you have a 1.5% management fee and a 10% incentive fee that the manager charges, okay? But let's say it's yielding, they're going to give you a 12% yield on this credit, paid quarterly. Typically, though, they will have what's called a preferred return, where until you get all your money back, plus 7% annualized, we don't get our 15 or 10% incentive fee. And so you're aligned.
So I like that structure.
That's what it is for most
That's how it's
ones.
supposed to work. And so these interval funds, to your point, are just like layering fees. They're charging fees on the leverage, and there's no incentive that the manager really doesn't get paid. That carry is what the private manager is going to live off of. Yeah. He doesn't get paid until you get all your money back plus your preferred return.
Bryn,
that doesn't exist.
Is there also some element to this where, why would the better managers of something like this be at a retail interval mutual fund? Well, the better managers are probably private funds.
Well, it's harder to raise capital. A lot of these funds, you have to have $5 million of liquid assets exclusive of your home. And so these managers would love to be able to go out to non-qualified purchaser clients below 5 million, whether it's in below even accredited. And so I think there's a big incentive for these managers to create these liquid structures.
And to take more risk.
And to take
with more leverage. If they're charging on the
higher fees.
leverage, that's wild.
Right. So in the private investment world, that would be like a manager charging on what's called the subscription line, and that's a no-no. That's just like, so this is a product that seems on the surface to the way Jason's laying it out on the surface, because I don't think you can categorize.
They're not all
funds.
bad.
No, he actually writes about one where it was called Cliff something.
Cliffwater.
Do you know them?
Like
Cliffwater?
AQR?
No. Cliffwater's one of the.
No, that's Cliff Asmus.
Oh, that's Cliff Asmus.
They're one of the biggest. They're one of the biggest in the space.
No, he writes about one where they don't charge a fee on the leverage.
Yeah.
Which seems like that should be the industry standard, but the industry standard is the other way.
Right.
You have thoughts on these?
Well, I mean, I know ETFs are trying to figure out the private equity thing, and it's a spot that seems pretty safe for now, but just more philosophical. ETFs always kind of find a way. I don't know how they're going to solve the private equity, private asset thing, but
that might be the final frontier.
Look at something
how
like,
do you have daily trading?
Yeah.
No, fees always find a way. There will be an ETF for these private assets, and it's not going to go well.
I think Grayscale is a perfect example. Right before the Bitcoin ETF come, think about how much 2.5% on their trust.
Mm-hmm.
Then the ETFs got that approved, and then look how they were forced to cut. I think something like that will happen. I don't know the logistics of how they get there, but ETFs always find a way.
I have the answer already.
Tokenization.
No, there's 7 or 8 publicly traded private credit / private equity firms.
So you're saying just own Blackstone and
put them in an
those?
ETF.
Those exist, yeah. Like KKR, and there's a couple from Invesco.
But they're always like wrapped up in like the whole financial sector. Just give me Ares. What are the public ones?
KKR,
Blackstone. Apollo, Carlyle,
Blue Owl.
So throw those all in an ETF and buy that. I'd rather have the GP fees than the LP
There you
fees.
go.
Yes.
I've heard the pitch about trying to buy like small cap growth as a proxy. What do you think about that? People are saying, well, buy small cap growth
Can I
as a
read this
proxy
to
for
you?
private
So
equity.
this is how Zweig's article ends. It's hard to with this. Leading ETFs investing in public high yield bonds have yields of 7 to 8% and total expenses well under 1% without making you wait up to half a decade to get your money out. Given the high expenses on many interval funds, quote, after you do the math, you're at best only a point or two ahead of a public high yield fund. And is that extra yield worth the liquidity you give up to get it? That's Morningstar analyst Brian Moriarty. So that's the question. It's a tough question to answer.
Yeah, but I will say the theory of the interval fund, you're not going to be down 25% like you're going to be down on high yield. So it's like, I think it's a little bit of apples and oranges. You're just looking at the yield on high yield, not looking at the price fluctuation.
Yeah, they're not the same thing.
They're not the same thing.
We agree with that. Okay, you guys have fun on the show today?
So much fun.
Yeah, this was awesome.
You want to do it one more time just to make sure we got it, or you think we got it?
Ready to go?
Did you finish the Rubik's?
I had these two. I didn't want to do it. So basically, I can finish it after the
You're very smart.
Pull out those meta glasses and tell me what's going on now, because I saw you when you first got them.
Yeah, we took pictures. Okay, really quick. So do you have WhatsApp?
Have you seen these in the wild yet?
I heard you told me about them when you saw them.
Do you have WhatsApp?
I have WhatsApp, but like I might not be logged in.
I need to call you. So here's the deal. I can put them on.
Okay.
I'll take them off. I can put them on now. This is just a new update. If I call Josh on WhatsApp, and then all of a sudden there's a little camera that comes, a little sunglasses. I push the sunglasses, and Josh can see what I see.
That's
nuts.
Cool. So we were on vacation, and I was calling my friend, and we were in the mountains, and I was like, hey, she was like walking on the trail.
Your phone number is no longer registered with WhatsApp on this phone.
I bet these are so great. They cost basically the same as Ray-Bans.
So you can give me.
I call you on WhatsApp.
So you could be. Let's say you're in the Vatican taking the tour, and I couldn't make the trip. So because I'm your elderly grandmother, and you say, "Grandma, look where I am."
Yeah.
And then on my phone, I'm watching what you see on your glasses.
100%.
That's dope shit, right?
It is such great clarity. It's like a 12 megapixel camera, and then I don't know if it's 1080, but it feels like 1080.
Now, do you
on the
see
video.
the other person? Is there like a?
Oh, there's a little on my phone.
On your phone. Okay.
There's a little picture of the person, but I'm just looking at. My phone could be in my pocket.
And what about the audio?
Amazing. I listen to music and talk on the phone all the time. And like on the earbuds.
People think you're talking to yourself.
They do. I was walking up here because you have those AirPods on. If someone sneezes, it sounds like an engine blew up.
Yeah.
On these, it's like you can't hear anything.
When you're walking around with those, you could say to the glasses, because the glasses have a receptor for sound, a microphone. So you could say to the glasses, I I want to walk to the nearest 7-Eleven, whatever. And it'll just give you guidance visually, or it'll talk to you?
No, not so much. It
It'll say
doesn't
make a left?
You still need to use your phone for that. You still
Okay.
need to go to the maps, but once it's on the maps, it can talk. But really, it's like I'd say, "Hey, Meta, take a picture." I can push a button, but we were like traveling, and no cameras were allowed, and my kids have them too, and so we're like, "Yeah, no cameras allowed."
Oh, you guys like spies?
So we're like, "Hey, Meta, take a
Is
picture."
it like spy? They're like spy kids. All right.
Yeah.
Very, very
All
cool.
good.
Hey, we always ended the show with favorites, and I'm gonna go last today. Michael, do you have a favorite for us?
I do.
All right.
So the Rewatchables, which is my favorite podcast, did a 2-part on Pulp Fiction. It was 4 hours long. And
I'm all in.
I rewatched Pulp Fiction.
Yeah.
Probably the movie I've seen the most, I guess. And it was always like cliche to say that Pulp Fiction is your favorite movie. I'm not afraid to say it. It is my favorite movie. So I rewatched it in full for the first time in a while. And absent that one weird scene with Butch's girlfriend, it really does fly. And it's 2 hours and 30 minutes, and it flies. And it is, in my opinion, for me, it's my favorite movie ever.
Wait,
It's-
what's Butch's? Oh, whose chopper is that?
Yeah,
I
Zed's
don't-
dead, baby.
I still don't
Zed's
understand
dead.
that.
It's
baby,
just
Zed's
the
dead.
best,
It
my
is.
favorite movie ever.
Very nice.
Not afraid to say it.
I like it.
I love that movie.
All right, Tom, do you have a favorite for us? Anything you're
Pulp
reading,
Fiction
watching?
is in my top 5. We're doing movies? Or
Not
anything?
anything. You
Your
can tell
favorite
us what-
ETF?
Yeah, what's your favorite ETF? What's going to perform best tomorrow?
Oh man, that's gonna. I mean, it's. I'm a pretty boring investor. It's hard to go against like the VOO.
What's your favorite thing in the world right now that you're into? What are you doing this summer?
Oh man, this is gonna be so. I might be the candidate for the most boring.
All right, we
You
like
like
that.
boring?
I'm like super into New York history, so
Okay,
I'm
me
like,
too.
there's actually a test to get your tour guide license.
Okay.
So I'm actually studying for. Apparently, like I know you had to get the
I
license.
love
but like,
that.
Yeah,
So
so I'm
cool.
like just.
Wait, what? Where do you want to give tours?
Just it's actually just more for myself, but I'm not like trying to like.
I know,
go-
you're giving me a tour.
I'm always just like walking around. There's like so much
Do you do
history
that in the
here.
financial district?
That's my favorite part.
That
of the
is the
city.
best part of the city.
Yeah.
for
So
that.
when
so
I got
much.
kicked out of college the first time, I was at Nassau Community College. Oh no, maybe Queens College. I can't remember where I was. I took a class. It was a walking tour class of New York City. And I grew up on Long Island. Like I didn't grow up in the city. And I learned so much and had it was memorable. So when you get your certification or even before it, I'm down. Let's do it.
when you walk
so much fun.
around, when you walk around Stone Street, Pearl Street, the whole financial district, it's like among the most historic places in the Western world.
Yeah, it's so much, and you kind of just see how the city had built from there. And I live in Brooklyn Heights, which is like also like a really historic place. So
Yeah.
it just starts with like walking around with my friends, and I'll drop these random facts, and like you're such a nerd. Like no one, it seems like no one cares, or like you'd walk in like, did you know that street? That's
Bro,
how it got its name and whatnot.
Get
Like,
smarter friends.
Yeah,
Because I think
yeah,
that's
they
cool.
always just
'cause I
make
think
fun
that's
of me.
cool.
What's
I love
historic
it.
around Midtown? Where we are?
Oh, this one, Crystal Palace.
What's
Nikola
that?
Tesla Street was
Yeah.
right there.
So, we're at Bryant Park,
Funny you
right?
should mention that.
Yeah.
I didn't know that. But all right, so we're at Bryant Park. There used to be this convention hall called Crystal Palace.
Like in England, it was
Yes,
it was
they
mirroring
mimic
Hyde
it
Park.
after that.
Yes.
So it's like this stunning glass building. It only lasted for a couple of years. It burned down. But Otis had like even showcased an elevator in there, and it was just right here at Bryant Park. And then there was this big reservoir at New York Public Library, and if you actually go down there, you can see the old like stone.
And do you know it? And you know it was right next to it, the Hippodrome. Do you know about
yes,
that?
yes.
So we had horse racing, right in the middle of the city, and there's still a building on 6th Avenue called the Hippodrome Building. But we literally had like an open air. It was not like in an arena. It was like an open air like horse tracks,
Yeah,
like
it's
in
amazing.
Rome. Did you read New York by Rutherford?
Yes, I did.
Okay.
And Gotham, I have a bunch.
Okay.
I'm really into like the Boss Tweed era too.
Yeah.
All that. There's just so much history.
Love it. It's
See?
so cool.
Brought us an amazing favorite.
Yeah, thanks.
You're so interesting.
I want to take the tour with Michael. So tell us.
We'll
And
come
Bryn
back.
definitely wants to
I
take the tour.
definitely
All right,
wanna
well, I'll do.
go.
We'll
All right,
arrange a tour.
Bryn, what do you have for us?
Okay, so a book everybody should have in their house. I have it on my Kindle. My kids have it. It's called The Magic of Math.
Okay.
Everyone should have it. This guy, obscure book, Arthur Benjamin. Okay, so I'm gonna do a little thing, little teaser.
Do it.
So don't say it out loud, okay? So pick a number between 20 and 90, okay?
Got it.
I'll do mine. I'll say it out loud so you can follow with me. Mine's 35, okay? Add the two digits together, okay? So mine would be 8, okay? Add your digits. Now, subtract that number from the original number. So mine's 35 minus 8. You have that?
Yeah.
So you have your new number.
Okay.
Now, add those 2 digits together. Tell me when you've added them together.
Okay.
Everyone's number is 9.
Wait, how did you do that? Did it work for you too?
But I actually chose 35 too.
Everyone's
But
number
I don't know
is-
if it was like a.
Yeah, I also chose 35.
Well, it doesn't matter. You can pick any number. Everyone's number.
Tell us about TurboLearn.
Okay, so I love technology. Obviously, I'm a gadget person.
Yeah.
I have a Plod thing on my phone. I don't use it that much anymore. There's this great desktop app for AI called turbolearn.ai. Your kids should for sure use it. Like my kids are in college. I think you've got college.
Almost.
College,
Yeah,
almost.
almost.
So TurboLearn AI, it does a great job. You can record it. You can insert a PDF. And so last night I recorded the Meta earnings. And what's amazing about it, it picks up on the nuances. It gives quotes. It puts tables for you together. So it's not a transcript. It is a summary that you feel, I think it's the most accurate summary I've seen from earnings calls. And so if you think about our industry, how many junior investment bankers have to sit and listen on these calls? It's like that's done because the output from TurboLearn, it's at turbolearn.ai is exceptional. You can insert a PDF. Also, great summaries.
So let's say average conference call is 45 minutes, right? 30 minutes boilerplate, 15 minutes Q&A-ish.
Yeah.
What's the output? Like 5 minutes worth of reading?
Yeah, maybe 5
Amazing.
minutes.
Love it.
Yeah.
That is amazing. Quarter has one too, just saying.
They have a transcript, which I love.
No, but they have a new AI thing where it summarizes the
Oh.
transcript in like 2 seconds.
All right, stop glazing
I'm
quarter.
just saying,
We did
I'm
enough
just
of that.
saying.
All right, I want to say Evan Gershkovich is free. This is to
Yay.
me like the best news story of the year. Like literally, unless the USA basketball team wins the Olympics, then that'll be neck and I don't
No,
know.
Evan,
Like, what
this-
else makes people feel good? This
I know.
makes people feel
Two
good.
prisoners released.
Yes, multiple prisoners. I should say that. But so for people that don't know Evan's story, he's a Wall Street Journal reporter. He was reporting on Russia, which is the country his parents are from. He was a Russophile. He was traveling the country, trying their restaurants, and they used him to basically get a hitman that they thought they might be exchanging for Navalny. Navalny died. They picked this kid up off the street a couple of weeks or months later and basically held him for over a year. His parents are here in the United States just freaking out every single day. The Wall Street Journal has been screaming like from the front page, free Evan. And they finally got it done. And I want people to read the whole story, all the stuff they couldn't release over the last year. The Wall Street Journal has had teams of reporters on this. You will not believe how good this story is. It's like a Captain America movie. Like it's incredible.
So
they have Green Berets who are negotiating and like lawyers and people in the White House and then people in countries all over the world. So please go to wallstreetjournal.com and read all of the stories they just put out today about Evan and his release and the negotiations. And this should definitely be a movie because it's
Love
like
it.
an incredible thing that happened. So we like freedom. All right, that's it for the show this week. Guys, thank you so much for listening. Special thanks to our guests. I want to tell you where you can follow them. Bryn, you are at Bryn Talkington on Twitter. And let's spell this out.
Tom.
No, Tom. Let's spell this out for people. You are on Twitter and you are at Psarofagis on Twitter. And you're doing incredible stuff with Eric Balchunas, friend of the show,
And James.
James
they're all
Safar.
part of the same team.
Okay, dude, you guys are the best in the biz covering ETFs. So people who want to follow, people want to learn more about ETFs or keep track of what's happening, definitely follow Tom. Thank you so much for doing the show. Thank you for coming back and doing the show.
So fun.
Thanks for having me.
Thanks, John, Duncan, Rob, Graham, Nicole, Sean, everyone who helps us with the charts each week. We appreciate you, Daniel.
Daniel.
And guys, see you next time. Take us out.